Picture this. Banks across China are literally giving away properties at 30% off, and still, nobody wants them. We're not talking about a few dozen houses in some forgotten village. We're talking about over 4 million foreclosed properties flooding the market right now, with experts predicting this number will explode to over 2 million units just by 2027. This isn't just a real estate problem anymore, folks. This is a full-blown financial crisis that's about to shake the world's second-largest economy to its core. If you care about the global economy, if you've got investments, if you're just curious about what happens when a $19 trillion economy starts crumbling from the inside out, you need to stay with me for the next 30 minutes. And hey, before we dive deep into this disaster, smash that like button and subscribe to the channel because we're about to unpack one of the biggest financial crises of our generation, and you don't want to miss what's coming next. Let me paint you the full picture of what's happening right now in rural China. We're in January 2026, and Chinese rural banks are facing an absolute nightmare scenario. They're sitting on hundreds of thousands of foreclosed properties that they desperately need to sell. But here's the kicker. Even when they slash prices by 20 to 30% below market value, they still can't find buyers. Think about that for a second. Imagine walking into a bank auction where a beautiful 160 square meter apartment, originally worth 2 million yuan, that's about 272,000 US dollars, is being sold for just 1.35 million yuan, roughly $192,000. That's a massive discount, right? But guess what happened? The Bank of Jilin and Dalian tried to auction this exact property not once, but twice, and both times crickets. Nobody showed up. Nobody bid. The property just sat there, unwanted, unloved, a ghost of China's once booming property market. Now you might be wondering, why should I care about some rural banks in China having trouble selling houses? Well, buckle up, because this goes way deeper than you think. These aren't isolated incidents in some backwater towns. We're seeing this crisis explode across entire provinces. In Gansu province alone, banks offered 4,292 properties for auction last year. Let me repeat that, 4,292 properties in just one province. And you know what makes this even more terrifying? In 2023, Gansu banks only had 478 foreclosed properties. That's an increase of almost 900% in just 2 years. 900%, people. But wait, it gets worse. In Sichuan province, banks listed 1,909 properties in 2025 compared to just 370 in 2024 and 248 in 2023. In Jilin province, the numbers jumped from 371 properties in 2024 to 1,696 last year. And in Shaanxi province, listings went from 457 to 519. Across the board, we're seeing the same pattern. Rural banks desperately trying to dump foreclosed properties onto a market that doesn't want them. According to a November report from UBS, banks across China have cumulatively put up an estimated 1.35 million properties that they acquired through defaults since mid-2024. 1.35 million properties. And here's where it gets really scary. UBS estimates that the volume of foreclosed properties nationwide will surge to 2.43 million units by 2027, up from 640,000 units in 2025. We're talking about nearly a 400% increase in foreclosed properties in just 2 years. Now, let's talk about why this is happening, because understanding the cause is crucial to grasping just how serious this crisis really is. To do that, we need to rewind to 2021, when the Chinese government decided to implement what they called the Three Red Lines policy. This policy was designed to rein in aggressive borrowing by property developers. Sounds reasonable, right? The government basically said, hey developers, you can't just borrow money like there's no tomorrow. You need to have a liability-to-assets ratio of less than 70%, a net gearing ratio of less than 100%, and enough cash to cover your short-term debts. On paper, this makes perfect sense. It's responsible regulation aimed at preventing developers from over-leveraging themselves. But here's the problem. This policy didn't just slow down risky borrowing. It triggered a financial earthquake. And ground zero for this earthquake was a company called Evergrande. Now, if you don't know about Evergrande, let me give you the quick version of one of the most spectacular corporate collapses in modern history. Evergrande was founded back in 1996 by a guy named Hui Kai-yen, who went from being a rural steel worker to becoming one of China's richest men. By 2017, Evergrande was the second largest property developer in China. By 2018, it was the most valuable real estate company in the entire world. We're talking about a company with land reserves large enough to house 10 million people. They had their hands in everything: real estate, electric vehicles, theme parks, football clubs, you name it. But Evergrande had a fatal flaw. It was built on a mountain of debt. When the three red lines policy hit in 2021, Evergrande crossed all three lines. All three. The company couldn't meet any of the requirements. And suddenly the money stopped flowing. Evergrande had over $300 billion in debt, and it couldn't pay it back. In August 2021, Evergrande warned the government it was at risk of a cash crunch. Share prices plunged. Global markets panicked. And by December 2021, Evergrande defaulted on an offshore bond payment. The crisis had officially begun. But here's what makes this situation so much worse than just one company failing. Evergrande wasn't alone. The crisis spread like wildfire. Country Garden, one of China's other top developers, started facing similar problems. Kaisa Group, Fantasia Holdings, Sunac, Sinic Holdings, Modern Land, all of these major developers started collapsing one after another. By the end of 2021, 14 of China's 30 biggest developers had violated at least one of the three red lines regulations. These companies had combined sales of over 4 trillion yuan, that's about $672 billion in 2020. Since 2020, 77 property developers have defaulted on their debts. 77. And here's the kicker. These weren't fringe players. These were the companies that were building China's cities, housing its middle class, driving economic growth. The property sector in China wasn't just some small part of the economy. At its peak, real estate accounted for about a quarter of China's entire GDP. Think about that. 1/4 of a $19 trillion economy was tied to property development. When that sector goes down, it doesn't just affect developers and banks. It affects everyone. Let's talk about what this crisis means for ordinary Chinese people, because this is where the human cost becomes really clear. In China, housing isn't just a place to live. It's the primary way that families build wealth. Between 2003 and 2014, Chinese housing prices rose by more than 10% per year adjusted for inflation. People saw their home values skyrocket, and they felt wealthy. They spent money. They invested in their futures. But now, from the peak in 2021 until now, housing prices have dropped by 35%. 35%. Imagine waking up one day and realizing that your home, your biggest asset, the thing you probably save your entire life to buy, is now worth 65% of what was just a few years ago. And it's not just the loss of wealth that's devastating. Remember, in China, a lot of people bought properties that weren't even finished yet. They paid up front for apartments that developers promised to build. An estimated 2/3 of Evergrande's obligations alone are to homeowners who prepaid for close to 1.4 million residential properties that remain undeveloped. 1.4 million families waiting for homes that might never be built. 1.4 million families who gave their life savings to developers who went bankrupt. Can you imagine the anger? The frustration? The sense of betrayal? This is why we're seeing what's happening with the rural banks now. These banks lent money to developers and small businesses using properties as collateral. When developers and borrowers couldn't pay back their loans, the banks seized the properties. But here's the problem. The properties are now worth way less than they were when the loans were made. A bank might have loaned someone 2 million yuan against a property that's now only worth 1.35 million. So even if they sell the foreclosed property, they're still taking a massive loss. And rural banks, unlike the big national banks, don't have huge capital reserves to absorb these losses. They're smaller, they're more exposed to local markets, and they're getting crushed. Li Yukai, a real estate agent in Dalian, Liaoning province, summed it up perfectly when he said, "The prices are shockingly low." Currently, banks have a very large supply of foreclosed properties. And here's another layer to this crisis that we haven't even touched on yet: COVID-era business loans. During the pandemic, banks issued tons of small business loans to help companies survive. But now, as the economy struggles to recover, many of these small businesses can't refinance their loans. They're defaulting, and banks are having to seize whatever collateral they have. This creates a fresh wave of distressed assets flooding an already oversaturated market. Now, let's talk about the debate happening among economists and analysts, because there are some really interesting perspectives on where this crisis is headed and what it means for China and the world. On one side, you have people like Xiao Xizhong from Gavkal Dragonomics who argue that banks need to cut their losses now. She says banks holding onto foreclosed properties are unlikely to see prices recover, so it's better to sell earlier and cut losses. Her perspective is essentially, the market isn't coming back anytime soon. Get out while you can, even if it means taking huge discounts. And her analysis has merit. She also points out that the lack of substantial government support policies for the real estate sector suggests that regulators are taking a support but not stimulus approach. In other words, the government is trying to prevent a total collapse, but they're not going to pump massive amounts of money into bailing out the sector. On the other side, you have people like Tan Ming, a director at S&P Global Ratings, who's sounding the alarm about what happens if these fire sale prices become widespread. He warns, if this becomes widespread, it would be unsustainable as it would undermine real estate market stability and trigger government intervention. His concern is that if banks keep dumping properties at 20 to 30% below market value, it creates a downward spiral. Those discounted sales become the new market price. People who own properties see their values plummet even further. Consumer confidence collapses. Spending drops. And the whole economy takes another hit. Both perspectives highlight a fundamental problem. There's no good option here. If banks hold on to the properties and wait for prices to recover, they're tying up capital they desperately need, and they're gambling that the market will turn around, which most analysts think won't happen for years. But if they dump properties at huge discounts, they risk creating a death spiral that crashes the entire market. It's a lose-lose situation. John Lam, head of Asia Property Research at UBS, isn't optimistic about a quick recovery. He forecasts that property prices will continue declining, dropping about 10% in 2026 and another 5% in 2027. He points out the entire industry still has oversupply. And that's the fundamental problem. China built too much. There are ghost cities scattered across the country, massive developments with empty apartment buildings that nobody wants to live in. The demand simply isn't there to absorb the supply. Let me put this in perspective for you. The Chinese property market downturn that started in 2021 is the longest and deepest in China's history. We're now in year 5 of this crisis, and there's still no sign of a turnaround. This isn't a temporary dip. This isn't a market correction. This is a fundamental restructuring of the second largest economy in the world. And the ripple effects are already being felt far beyond China's borders. Let's talk about the broader economic implications, because this crisis isn't happening in a vacuum. China's GDP growth has been slowing. In 2025, the economy grew 5%, hitting Beijing's target, but that's well below the historical trend of about 8% that China maintained between 2000 and 2025. And when you look at the fourth quarter of 2025 specifically, growth slowed to just 4.5%, the weakest in nearly 3 years. Consumption, which should be a key driver of economic growth, is struggling. Retail sales grew just 0.9% year-on-year in December 2025, the slowest growth since Beijing lifted its COVID restrictions in late 2022. Here's what's really concerning. Consumer confidence is shot. People aren't spending money because they feel poorer. Their biggest asset, their home, has lost a third of its value. They're worried about job security. They're seeing developers go bankrupt and small businesses fail. So instead of spending, they're saving. And when people stop spending in an economy as large as China's, it doesn't just affect China. It affects the entire world. Think about the global supply chains that depend on Chinese consumers buying products. Think about the multinational companies that rely on China's middle class for growth. Apple, Nike, Starbucks, all of these companies have massive exposure to the Chinese market. If Chinese consumers aren't spending, these companies feel it. And it's not just consumer goods. The construction slowdown affects demand for steel, cement, copper, all the raw materials that go into building cities. Countries like Australia, Brazil, and Indonesia that export these commodities to China are already seeing the impact. But here's where it gets even more interesting from a geopolitical perspective. China's response to weak domestic demand has been to double down on exports. In 2025, China's trade surplus reached a record high of nearly $1.2 trillion. $1.2 trillion. Chinese companies are flooding global markets with cheap goods, trying to make up for weak domestic sales. This is creating huge trade tensions. The United States and Europe are accusing Chinese firms of dumping excess stock at below market rates, which is hurting domestic manufacturers in those countries. This is setting the stage for increased protectionism, tariffs, and trade wars that could fragment the global economy. Now, let's bring this back to the rural banks and ask a critical question. What happens if this crisis gets worse? Because right now, we're still in what analysts call the early stages of the non-performing asset disposal cycle. The foreclosed properties we're seeing now, the 1.35 million units that have hit the market since mid-2024, that's just the beginning. UBS estimates we could see 2.43 million foreclosed units by 2027. But what if even that estimate is too low? What if the economic slowdown accelerates? What if more businesses fail? What if unemployment rises? Here's the scary part. China's banking system isn't as transparent as banking systems in Western countries. We don't have perfect visibility into how much bad debt is really sitting on bank balance sheets. Official non-performing loan ratios might look manageable, but analysts have long suspected that the real numbers are much higher. Banks in China have ways of rolling over bad loans, extending terms, restructuring debt, all of which can hide the true extent of the problem for a while. But eventually the music stops. Eventually, you have to recognize the losses. And when it comes to rural banks specifically, these institutions are particularly vulnerable. They don't have the same access to capital markets as the big state-owned banks. They can't just raise money by issuing bonds or getting bailouts from a central government as easily. If losses from foreclosed properties start eating through their capital buffers, some of these banks could face solvency issues. And if rural banks start failing, that creates a whole new crisis. You get bank runs, people trying to pull their money out, which accelerates the collapse. The Chinese government is aware of this risk, which is why we're seeing some policy responses. The People's Bank of China announced a package of credit easing measures recently, including a 25 basis point cut in rates on various lending tools and increased quotas for lending programs targeting key sectors. The government has urged local governments to ensure speedier lending to cash-strapped developers. There have been reports of plans to mobilize state-owned companies to take over unsold homes from distressed developers. Beijing is trying to stabilize the situation without resorting to a massive stimulus package that would balloon debt even further. But here's the debate: is this enough? Andy Lee, CEO of Centerline China, puts it bluntly: unless selling prices are very attractive or the projects are in good locations, it's almost impossible to find clients for these banks. The housing markets are already bad with few sales. The fundamental problem is that demand is weak. People don't want to buy properties right now, even at discounted prices, because they're worried prices will keep falling. Why buy today when it might be cheaper tomorrow? This creates a self-fulfilling prophecy where falling prices reduce demand, which causes prices to fall further. Some analysts, like Xiao Xizhong from Gavekal, believe that this trend could herald a broader cycle of non-performing asset disposal in the banking system, similar to what China experienced in the late 1990s and early 2000s when the government had to create massive asset management companies to deal with bad loans in the state banking sector. Back then, China offloaded pervasive non-performing loans to clean up bank balance sheets and restart lending. Could we see a similar scenario now? It's possible, but the scale would be much larger given how much the economy has grown. Let's talk about some of the structural factors that make this crisis particularly difficult to resolve. First, there's the issue of oversupply. China went on a building boom for decades. Local governments relied on land sales to fund their budgets. Developers borrowed heavily to acquire land and build massive projects. The result was an enormous amount of housing stock, much of it in locations where demand is weak. Second-tier and third-tier cities, the ones where rural banks are most exposed, saw massive construction during the boom years. But now, with urbanization slowing and demographic trends shifting, there simply aren't enough people who want to live in these places. Second, there's the demographic challenge. China's population is aging rapidly. The working-age population is shrinking. Younger generations are facing higher unemployment and lower wages relative to housing costs than previous generations. Many young people are delaying marriage and childbearing, which reduces household formation and, by extension, demand for housing. This isn't a temporary demographic blip. This is a long-term trend that fundamentally changes the demand picture for housing in China. Third, there's the shift in consumer attitudes. For decades, Chinese people viewed property as a can't-lose investment. Prices always went up. Buying property was how you secured your family's future. But the crisis has shattered that belief. Now people are much more cautious. They're questioning whether property is really a good investment. They're more likely to rent instead of buy. They're more likely to invest in other assets or simply save their money. This psychological shift is huge and will take years, maybe even a generation, to reverse. Fourth, there's the political dimension. The Chinese government under Xi Jinping has emphasized the principle that property is to be lived in, not to be speculated on. This represents a fundamental shift in how the government views the property market. For years, property speculation was tacitly encouraged as a way to drive growth and create wealth. But now the government is trying to definancialize housing to make it less of an investment vehicle and more of a place to live. This is a massive policy shift, and it means that the government is unlikely to implement the kind of broad-based stimulus that would reinflate the property bubble. So where does all this leave us? Let me try to synthesize the different perspectives and give you a sense of the range of outcomes we might see. On the optimistic end, you have analysts who believe that China can manage this crisis through a controlled deleveraging process. The government supports the banking system, prevents widespread failures, gradually works through the bad debt, and the economy eventually stabilizes at a lower but more sustainable growth rate. This scenario avoids a catastrophic collapse but requires years of painful adjustment. On the pessimistic end, You have analysts who worry that the crisis could spiral out of control. If property prices keep falling, if banks start failing, if unemployment rises sharply, you could see a much more severe economic downturn. Consumer and business confidence could collapse, leading to a prolonged period of deflation and stagnation. This would have massive global implications, potentially triggering a worldwide recession given how interconnected the global economy is with China. The most likely scenario probably falls somewhere in between. China will likely muddle through, using a combination of monetary easing, selective bailouts, state-directed asset purchases, and regulatory forbearance to prevent a total collapse. But the process will be messy and painful. We'll continue to see developers fail, banks struggle with bad loans, property prices decline gradually over several years, and economic growth remain below historical norms. The days of China growing at 8 or 9% are over. The new normal might be more like 3 to 4% growth, with occasional quarters even lower. And here's what we need to understand. This isn't just about China. The global economy has relied on China as a major engine of growth for the past 2 decades. Multinational corporations have built their strategies around the assumption of a rising Chinese middle class with increasing purchasing power. Commodity exporters have counted on Chinese demand for raw materials. Financial markets have priced in continued strong growth from the world's second-largest economy. If China's growth slows significantly and stays slow, all of those assumptions need to be revisited. We're also seeing this play out in geopolitical terms. China's economic struggles are affecting its foreign policy. The Belt and Road Initiative, China's massive infrastructure investment program across Asia, Africa, and beyond, is facing challenges as China has less capital to deploy and countries that borrowed from China are struggling to repay loans. China's ability to project soft power through economic influence is diminishing. At the same time, the trade tensions created by China's export push are creating friction with the United States and Europe, potentially leading to a more fragmented global trading system. Let me give you one more angle to think about: the financial contagion risk. While analysts like U.S. Treasury Secretary Janet Yellen have downplayed the potential for major global spillovers from China's property crisis, the reality is that we live in a deeply interconnected financial system. Chinese property developers issued billions of dollars in bonds that were bought by investors around the world. When Evergrande defaulted, European and American investment funds that held those bonds took losses. If more defaults occur, if Chinese banks start failing, there will be ripple effects through global financial markets. Moreover, many global banks have exposure to China through their operations in the country. If China's economy deteriorates significantly, these banks could face loan losses on their China portfolios. We've seen in past crises, whether it's the Asian financial crisis in 1997 or the global financial crisis in 2008, that seemingly localized problems can quickly spread through the global financial system. The world is too interconnected for a crisis in an economy as large as China's to remain purely domestic. So what should we be watching going forward? First, keep an eye on the foreclosed property numbers. If we start seeing the foreclosures accelerate beyond even the dire UBS projections, that's a sign the crisis is worsening faster than expected. Second, watch Chinese consumer confidence and retail sales data. If consumption continues to weaken, that signals that the wealth effect from falling property prices is really biting. Third, monitor the health of Chinese banks, particularly smaller regional and rural banks. Any signs of bank failures or liquidity problems could indicate a more serious systemic crisis. Fourth, pay attention to Chinese government policy responses. If Beijing starts implementing much larger stimulus measures, property bailouts, or banking system support, that suggests the situation is more serious than official data indicates. Fifth, watch global commodity prices. A sustained drop in copper, iron ore, and other industrial commodities could signal that Chinese construction and manufacturing are slowing more than expected. And finally, keep an eye on Chinese capital flows. If we start seeing significant capital flight, with wealthy Chinese moving money out of the country, that's a warning sign that domestic confidence is collapsing. Here's my take, and this is where the debate really gets interesting. I think we're witnessing a fundamental restructuring of the Chinese economy that will take years to play out. The property-driven growth model is broken, and it's not coming back. China is going to have to find new engines of growth, whether that's technology, green energy, advanced manufacturing, or domestic consumption. But that transition is going to be painful and messy. In the short term, we're going to see more bank struggles, more property developer failures, and continued economic weakness. The question isn't whether China will experience pain, it's how much pain and how long it will last. And critically, will the Chinese government's policy responses be effective enough to prevent a crisis from becoming a catastrophe? The track record so far is mixed. They've prevented a total collapse, but they haven't been able to arrest the decline. Property prices keep falling, foreclosed properties keep piling up, and consumer confidence remains weak. Some economists argue that China needs a Big Bang approach, a massive stimulus package combined with direct support for consumers to restore confidence and stabilize the market. Others argue that such an approach would just kick the can down the road, adding more debt to an already over-leveraged system without addressing the fundamental oversupply problem. The government seems to be threading the needle, trying to provide enough support to prevent collapse without creating moral hazard or reinflating bubbles. But here's the uncomfortable truth: there might not be a painless way out of this. When you have an economy that became overly dependent on property development, that built too much housing, that encouraged speculation and leverage, the adjustment back to something sustainable is going to hurt. The only question is who bears the cost: banks, property developers, homeowners, local governments, or some combination of all of them. What we're seeing with the rural banks struggling to sell foreclosed properties is just one manifestation of this broader crisis. These banks are on the front lines, holding assets that nobody wants at prices that don't reflect the loans they made. They're being forced to recognize losses that will eat into their capital and potentially threaten their survival. And because these are smaller banks without the political connections and resources of the big state-owned banks, they're more likely to be left holding the bag. This raises important questions about financial stability and fairness. Should small savers who put their money in rural banks lose their deposits if those banks fail? Should the central government bail out every troubled bank, even if it means rewarding poor lending decisions? Should property developers and borrowers who took on too much debt be allowed to walk away from their obligations, or should they be forced to pay? These aren't just economic questions, they're political and moral questions that Chinese policymakers are grappling with. And here's where I want to bring this full circle to the global implications. If you're sitting in the United States or Europe or anywhere else in the world, you might think this is China's problem to solve. But remember, China is the world's second-largest economy. It's the largest trading nation. It's deeply embedded in global supply chains. What happens in China doesn't stay in China. If Chinese growth slows significantly, if Chinese consumers stop buying, if Chinese companies dump cheap products on global markets to make up for weak domestic demand, the whole world feels it. We're already seeing some of these effects. Chinese exports surged in 2025 as companies try to offset weak domestic sales. This contributed to China's record trade surplus of nearly $1.2 trillion. But those exports are putting pressure on manufacturers in other countries. We're seeing increased calls for tariffs and trade protection in the United States and Europe. This could lead to a more fragmented, less efficient global trading system that reduces growth everywhere. At the same time, China's economic struggles could create opportunities. If Chinese consumers are buying less, where does that demand go? Could other emerging markets pick up some of the slack? If China's property sector is shrinking, could that create opportunities for property development in other countries? If Chinese banks are pulling back from international lending, could that create space for other lenders? These are the kinds of questions that businesses and investors need to be thinking about as they navigate this changing landscape. So let me wrap this up with some final thoughts. What we're witnessing in China right now with the rural banks unable to sell foreclosed properties despite massive discounts is a symptom of a much larger crisis. This is a crisis that started with government attempts to rein in excessive borrowing, accelerated with the collapse of Evergrande and other major developers, and is now manifesting in the real economy through weak consumer spending, falling property prices, and mounting bad loans in the banking system. The numbers are staggering. Over 4 million foreclosed properties since mid-2024, projected to hit 2.43 million by 2027. Property prices down 35% from their peak. Retail sales growing at the slowest pace since the end of COVID restrictions. A $19 trillion economy growing at just 5%, well below its historical trend. These aren't just statistics. Behind every foreclosed property is a family's shattered dream. Behind every failed developer is thousands of workers who lost their jobs. Behind every struggling bank is savers who put their trust in the system. The debate about what comes next is intense and unsettled. Will the government's measured approach of support, but not stimulus, be enough to prevent a catastrophic collapse? Or will the slow bleed of falling property values and mounting bad loans eventually overwhelm the system? Can China transition to a new growth model based on technology and consumption, or will it get stuck in a middle-income trap with weak growth and high debt? These are the questions that will shape not just China's future, but the global economy's trajectory for years to come. And here's my final message to you. Stay informed, stay engaged, and understand that what happens in China matters for everyone. Whether you're an investor trying to figure out where to put your money, a business owner trying to navigate global supply chains, or just someone trying to understand the world we live in, this story is far from over. The rural banks struggling to sell foreclosed properties today are the canary in the coal mine for a much bigger transformation happening in the world's second-largest economy. If you found this deep dive valuable, please hit that like button and subscribe to the channel. We're going to keep tracking this story as it develops, bringing you the analysis and insights you need to understand what's really happening beneath the headlines. Drop a comment below and let me know what you think. Are you worried about the global implications of China's property crisis? Do you think the Chinese government can manage this situation, or are we headed for a more severe downturn? I want to hear your perspectives because this is a conversation we all need to be having. Thanks for watching, and I'll see you in the next video where we'll continue to unpack the biggest economic stories shaping our world.